You are sitting in the same kitchen, 10 years from now, staring at the same phone. Your income is $260,000 a year. That is more than double the average full-time Australian salary of about $106,000. And yet your bank balance feels exactly the same as it did the day you crossed 100 grand. The mortgage is still there. The stress is still there. The feeling of running harder and getting nowhere is still there. That is not a future you have to accept. But it is the future waiting for most high-income Australians who never learn one simple thing. Earning more is not the same as keeping more. And the difference between those two numbers is the difference between a high-paying job and a genuinely wealthy life. So what is actually happening to your money every single pay cycle? And why does nobody warn you about the invisible hand taking more of it the moment you finally start earning real money? You have been told your whole life that earning more solves everything. Get the promotion, take the higher paying job, climb the ladder, and then you get there and discover something nobody mentioned at the career briefing. The tax system is not designed to reward high earners. It is designed to collect from them. The average full-time worker in Australia takes home about 78 cents of every extra dollar they earn once you factor in tax and the Medicare levy. But once you cross $190,000, the marginal tax rate hits 45% on every dollar above that threshold. Add the 2% Medicare levy, and you are keeping barely half of every extra dollar you earn. That is not a penalty for success. That is a structural reality that most high-income Australians never stop to calculate. And the quiet anger you are feeling right now, that is the exact emotion that changes everything. Because once you see the mechanism, you can work around it. But most people never look. Part 1. The 47-cent dollar. Here is the core idea. Once your income exceeds $190,000, every single extra dollar you earn is taxed at 47 cents when you include the Medicare levy. That means for every $1,000 of a pay rise, you actually see about $530 in your bank account. Now think about what that does to your motivation. You are working harder, taking on more responsibility, sacrificing more of your time, and the government is taking nearly half of every extra dollar you earn before you even see it. Compare two Australians. Both earn $250,000 a year. One does nothing. The other salary sacrifices $15,000 into superannuation before tax. That $15,000 is taxed at 15% inside super instead of 47% outside it. That is a saving of 32 cents in every dollar. Over 10 years, assuming average investment returns, that single decision creates a difference of over $100,000 in their retirement balances. Same income, same job, one decision. Have you ever actually calculated what your effective tax rate is on the last dollar you earn? Part 2. The mortgage that never shrinks. Here is the trap that catches more high earners than anything else. You finally have the income to buy the house you always wanted. So you do. The average new home loan in Australia is now $736,000. In Sydney, that number pushes past $870,000. At an average interest rate of 5.5%, your monthly repayment is over $4,180. Now here is what nobody tells you. The bank does not care how much you earn. They care about your serviceability. And the more you earn, the more they are willing to lend you, which means the higher your income, the bigger the mortgage they will approve, and the more of your future income they lock away before you even earn it. Compare two Australians earning $250,000. One buys a property worth $1 million. The other buys a property worth $700,000 and invests the difference in a diversified share portfolio using VAS or A200. 10 years later, the first Australian has paid over $400,000 in interest and still owes most of the principal. The second Australian has a smaller mortgage, lower interest payments, and a portfolio that has grown through compounding. Same income. 10 years. Completely different net worth. How much of your future income have you already committed to a bank before you have even earned it? Part 3. The superannuation penalty. Nobody mentions this is where it gets personal. If your income plus your concessional super contributions exceeds $250,000 in a financial year, you pay Division 293 tax. That is an additional 15% tax on your super contributions, taking the effective tax rate from 15% to 30%. So the government gives with one hand and takes with the other. The concessional contributions cap for the 2025 to 26 financial year is $30,000. If you earn $260,000, your employer is already contributing 12% of your salary, which is $31,200. You are already over the cap before you have made a single voluntary contribution. Every dollar above that cap is taxed at your marginal rate plus an excess contributions charge. Compared to Australians earning $260,000, one ignores their super entirely. The other maximizes their carry-forward concessional contributions from unused caps from previous years. Over a decade, that unused cap strategy can add over $150,000 to their retirement balance, tax-free on the way out after age 60. Same income, same super guarantee. One person retires with an extra $150,000. The other does not even know carry forward exists. Have you checked your unused concessional cap balance in MyGov this year? Part 4. The lifestyle. Inflation that eats everything here is the uncomfortable truth. Most high-income Australians do not feel wealthy because they are not spending like wealthy people. They are spending like people trying to look wealthy. The average single person in Sydney needs approximately $61,360 per year to cover all living expenses, including housing, food, transport, and recreation. That is the baseline. Now look at what happens when you earn $250,000. Your after-tax income is approximately $167,000 per year. After paying your $4,000 monthly mortgage, you still have over $117,000 left. And yet so many high earners feel broke. Why? Because every income increase brings a corresponding increase in spending. The better car, the private school fees, the more expensive holidays, the higher credit card limit. Compare two Australians earning $250,000. One lives on $120,000 and invests the rest. The other spends everything they earn. After 10 years, assuming a 7% average return, the first Australian has built a portfolio worth over $1 million. The second has built nothing but a collection of things that have depreciated. Same income. 10 years. One has financial freedom. The other has a garage full of stuff and a lingering feeling of emptiness. Is your spending actually making you happier, or is it just making you poorer? Part 5. The 15-minute fix that changes everything. Here is the part where everything comes together. You do not need to earn more money. You need to keep more of the money you already earn. And that starts with one simple mechanism. Salary sacrifice into superannuation up to your concessional cap of $30,000. That reduces your taxable income, saves you 47 cents in tax for every dollar you contribute, and grows your retirement balance inside a tax-advantaged environment. If you are over $250,000, you pay Division 293 tax, but the effective rate is still 30% instead of 47%. That is still a 17% saving on every dollar you contribute. Now, combine that with debt recycling. Convert your non-deductible mortgage debt into deductible investment debt by using an offset account or a split loan structure. Then use the equity in your home to invest in income-producing assets like VAS, A200, or a diversified ETF portfolio. The interest on that investment debt becomes tax-deductible against your high marginal tax rate. That is the mechanism. That is how high earners build wealth while everyone else just pays tax. Compared to Australians earning $250,000, one does nothing. The other implements salary sacrifice and debt recycling in a single afternoon with their accountant. 15 minutes of effort. 10 years later, the first Australian has a super balance of approximately $400,000 and a mortgage they are still paying. The second has a super balance over $550,000, a mortgage that is being paid down by investment returns, and a portfolio worth over $300,000 outside super. Same income. 15 minutes of difference. Over $500,000 in net worth. When are you going to take that 15 minutes? You started this video in a kitchen 10 years from now, staring at a phone, wondering where all the money went. That future is not fixed. It is a choice you are making right now, every single day, with every single financial decision. The system is not designed to teach you this. The banks do not benefit from you paying down your mortgage faster. The government does not benefit from you reducing your taxable income. The only person who benefits from you learning this is you. And the only person who can implement it is also you. The information is not the problem anymore. The action is. You now know exactly how the mechanism works. You know the numbers. You know the contrast between two Australians making the same income with completely different outcomes. The only question left is whether you will actually do something about it. Because 10 years from now, when you are sitting in that kitchen, you'll either be looking at a phone that shows a growing net worth, or you'll be looking at the same phone with the same stress, wondering why nobody ever told you. Nobody told you, but now you know.